Hi guys, good evening. Am I audible? Okay, fine. So as per your request, see many have requested me to start with IFRS 15 as many of you guys are facing difficulty in IFRS 15. So do you want me to start IFRS 15 from scratch? Please update in the chat box. Do you want me to start IFRS 15 from scratch? Guys, tell me, do you want me to start IFRS 15? I need everyone's response. I need everyone's response. Shall we start IFRS 15 from scratch then? If you guys are facing difficulty in IFRS 15, shall we start? Okay then. So let's start with IFRS 15. Okay. Oh, so you feel lease? Oh, we'll cover lease as well. Don't worry. We'll cover lease as well. So from yesterday's class, I felt like many of them are facing difficulty in IFRS 15 actually. So we'll start with IFRS 15 and then we'll move on to IFRS 16, that is lease. Is it okay for you guys? Shall we start? Okay, guys, fine. So we'll start with IFRS 15. I hope my screen is visible for you guys. Is it visible? Can you guys see it? Okay, fine. So let's start with IFRS 15. So what is IFRS 15? It is revenue. It is nothing but revenue. So let me ask you one thing. What is revenue? What is revenue? What is said to be a revenue? Sales. Okay. What is the core concept of revenue? Any idea? I'll give you the definition. Revenue is an income from the business core activity. Okay. You guys remember we discussed an example of a chocolate company yesterday, right? What is the revenue for the chocolate company? Selling chocolates. So whatever income they are earning in respect to selling what chocolates, we'll recognize it as what? We'll recognize it as revenue. Is it clear? Are you guys clear with the definition of revenue? Okay. Where will we show this revenue? In the financial statements. Where will we show this? Where will we show this revenue? Yeah, we'll show it in SOPL. Okay, fine. So, as per IFRS 15, there are actually 5 steps. There are 5 steps in order to recognize what? In order to recognize revenue, we use a 5-step model. Do you guys know what all are they? What is the first step? What is the first step that we'll use? What is the first step? Any idea? We use the five-step model. We use the five-step model. Yeah, exactly. What is the first step in this? It is to identify the contract. It is to identify the contract. What next? What is the next thing? What is the next step? What is the next step? What is the second step? Is to identify what? Identify what? Identify what? The second step is to identify the performance obligation. Identify what? Identify the performance obligation. Do you guys know what is performance obligation? What is performance obligation? Performance obligation. What is the performance obligation? See, performance obligations are the promises, right? They are the promises to transfer distinct goods or services to a customer. Got it? Is it clear? What is performance obligation? It is a promise to transfer what? Certain goods or services to a customer. Is it clear? Are you guys good with performance obligation? Is performance obligation. Now, what do we have in the third step? We have, yeah, exactly. Identify what? Identify the transaction price. Identify what? Identify the transaction or contract price. Identify the transaction price. What next? What next? What is the next step? What is the next step? The next step is to allocate this transaction price to performance obligation. See, you can see in a contract, in a contract, there might be different performance obligations. There might be multiple performance obligations. So, after finding out the transaction price, what we have to do? We have to allocate. We have to allocate the transaction price to what? To performance obligations. So it is allocation of transaction price. That is TP. Transaction price to what? To performance obligation. Performance obligations. What is the final step? What is the final step? Recognize revenue. When do we recognize revenue? That is a very important thing. When do we recognize revenue? When do we recognize revenue? Not where. When do we recognize revenue? Yeah, exactly. We'll recognize revenue once the transfer of control takes place, or we can say we'll only recognize revenue when the performance obligation is satisfied. Got it? Is it clear? Is the five steps clear? Are the five steps clear? Everyone, I need everyone's response. I need everyone's response. Is it clear, guys? Is it clear? So far, it's good, right? Okay, fine. So, I'll give you an example, okay? I want everyone to listen here carefully. See, let's say we have a company. We have a company. Let's assume that a company is a car retailer. A company is what? A company is a car retailer. Okay. So, what happened is a company, a company sold what? A company sold a car. A company, a company sold a car to a customer. Sold a car to a customer. Sold a car plus 2 years warranty. Plus 2 years warranty. 2 years warranty to a customer on 1st Jan 2020. On 1st Jan 2020. The contract price or the transaction price paid by the customer was how much? Let's say it is the customer paid how much? Customer paid $100,000. $100,000. So identify the contract. What is the first step? We'll identify the contract. Now tell me who is in contract with who? Who is in contract with who? Tell me. Who is in contract with who? Who is in contract with who? See, A company is in contract with customer, right? A company is in contract with customer. So we are done with the first part. What is the first part? What is the first step? What is the first step? A company is in contract with whom? Is in contract with customer. Is in contract with customer. What is the next step? What is the next step? I want every one of you to tell me what is the second step? What is the second step in recognizing a revenue? What is the second step? What is I want everyone to respond. What is the second step? What is the second step? We have to identify what? Yeah, we have to identify the performance obligation. What is the performance obligation here? What is the performance obligation here? What is the performance obligation of a company? I want everyone's response. What is a company's performance obligation? Is it only warranty for 2 years? Okay, what is the goods and service? What is the goods and service that has been provided by a company? What is the I want everyone's response? Yeah, car and warranty. Is it only car? Is it only the sale of car? Is it only the sale of car? Car and warranty. Car and warranty. So what is the obligation here? The obligation of a company is split into two, right? What is it? What is it? Car. That is sale of car, right? Sale of car. And then what? 2 years warranty. 2 years warranty. What is the third step? What is the third step? When everyone responds, what is the third step? What is the third step? What is the third step? Identify transaction price. What is the transaction price here? What is the transaction price in this scenario? What is the transaction price? What is the transaction price? What is the transaction price? It's 100,000, right? It's 100,000. Okay. So we are done with the third step, right? Now let's move on to the fourth step. What is the fourth step? We have to do what? We have to allocate, right? We have to allocate the transaction price. Let's say the transaction price of car is equal to how much? 80,000. Okay. Suppose the car price is 80,000 and 2 years warranty is how much? 20,000. Okay. Let's assume. Let's assume this is the case here. So we are done with the fourth step also, right? So what is the fifth step? What is the fifth step? What is the fifth step? Revenue recognition. When do we recognize revenue? That's my question. When do we recognize revenue? When do we recognize revenue? When do we recognize revenue? I want everyone to respond. When do we recognize revenue? Exactly. We will recognize revenue when the performance obligation is satisfied, right? We'll only recognize revenue when performance obligation is satisfied. So the fifth step is to recognize revenue. Recognize revenue when performance obligation is satisfied. Are you guys clear with this till now? Are you guys clear with this till now? Is there any doubt? Okay, fine. So now what you have to do is we have to prepare the FS, right? We have to know how this will be treated in the books, right? That's our main thing. What do we learn in financial reporting? How a transaction will be reported in the financial statements, right? So we have to learn what? How this will be shown in? How this will be shown in the statement of P&L and statement of that is the FS statements. So let's see. What is the year here? What is the year end? What is the year end? What is the year end here in this scenario? What is the year end? What is the year end? What is the year end? It's 31st December 2020, right? So we have to prepare FS on which date? 31st December 2020. FS. So now tell me how much amount will be shown. Sorry, what all this will be shown in SOPL? What will be shown in SOPL in respect to this transaction? What will be shown? What will be shown in SOPL regarding this transaction? What will be show in SOPL regarding this transaction? Tell me, I want everyone's response. What will we show in SOPL? Yeah, we'll show what? We'll show revenue, right? We will show revenue. What will be the revenue? What will be the revenue that will be shown? How much will be the amount? How much will be the amount that will be shown? How much will be the amount? Car 80K and warranty 10K. Okay, fine. Exactly. What will be the total revenue that will be shown? It will be 90,000. Does anyone have any doubt why it is shown as 90,000 instead of 100,000? Does anyone have any doubt regarding this? Okay. Coming. Okay. See, why 90,000? Okay. Now tell me, when do we recognize revenue? When do we recognize revenue? We only recognize revenue once the performance obligation is satisfied, right? We'll only recognize revenue once the performance obligation is satisfied. So what all are the performance obligation in this case? It's to sell the car and provide 2 years warranty, right? It is to sell the car. Have we sold the car? We have sold the car. So what is the transaction price of the car? 80,000, right? What is the transaction price of the warranty? It's 20,000. But how much years have passed? Only 1 year's warranty have been provided so far. 1 year is remaining, right? It is yet to be provided. Has the performance obligation satisfied for that 1 year? Have the performance obligation been satisfied for the remaining 1 year? It is for 2 years, right? Only for 1 year the performance obligation is satisfied, right? Only for 1 year the performance obligation is satisfied. The remaining performance obligation of providing warranty for another year is pending. It's not yet satisfied. So, will we recognize that 10,000 now? Will we recognize that revenue of 10,000 now? No. Did you guys get it? We won't recognize revenue until when? Until when the performance obligation is satisfied. Okay. So here, 1 year's revenue is still pending, right? It will only be satisfied in the upcoming year. So tell me, we'll show revenue of how much? 90,000. How did we get this 90,000? 80,000 of car plus 1 year warranty. How much is 1 year's warranty price? 1 year warranty, how much? It is how much? 10,000. That is 10,000. You guys understand this? Is it clear? For those who didn't understand this, is it clear? Okay, fine. Now coming on to SOFP. Will we show anything in SOFP? Will we show anything in SOFP? What will we show in SOFP? What will we show in SOFP? What will we show in SOFP? I want everyone's response. I want everyone's response. Liability. Why is it a liability? Because we have received the money, right? We have received the 100,000, but we are yet to provide the. It's not provision actually. We'll treat as liability. Okay. See, what is provision? Provision is liability of uncertain amount of time. Is this uncertain? Is this uncertain? No, right? So it will be liability. We know the exact amount and the exact time. Okay. So it's not provision. So coming on to SOFP, what will we show? We'll show liability. We'll show what? We'll show liability. How much will be the liability? 10K. We'll show this as deferred liability. Why are we showing this as deferred liability? Because we have already received what? We have already received the 10K. So as a result, we will be showing this as deferred liability under liability. That will be 10,000. Is this transaction clear, guys? Is this transaction clear? Is this 100% clear? This is the basics of revenue. I hope you guys are clear with this. Shall we move on? Shall we move on? Okay, fine. Now I want you guys to tell me what will be the journal entry for this transaction. Journal entry for this transaction. That is for the sales. What will be the journal entry? What will be on the debit side and what will be on the credit side? Tell me. Tell me the journal entry. Let me see if you guys are good with journal entry. Tell me what will be the journal entry. See, just think what is happening here. Just think what is happening here. Okay. Is it the only thing? See, what is happening here? We are selling this car with 2 years warranty, right? Yeah, exactly. See, we are selling this car. We are selling this car with 2 years warranty. How much are we getting? How much are we getting in cash? I want everyone to respond. How much are we receiving from the customer? How much are we getting from the customer? It's 100,000, right? It's 100,000. What are we receiving? We are receiving cash. So where will we show this cash in the journal entry? Where will we show this cash in journal entry? Where will we show this cash in journal entry? On the which side? We'll show it in the debit side, right? Because we are receiving cash, our cash is increasing. So debit cash, how much? How much will be the cash? How much is the cash that we have received? How much is the cash that we have received? How much is the cash that we have received? I want everyone to tell me how much is the cash? Exactly. It is 100,000. It is 100,000, right? Okay. So what about the credit side? We are receiving cash. We are receiving cash as a result of what? As a result of what? Sales, right? We are receiving cash as a result of the sales that has occurred. So credit, what? Credit, sales or revenue? What is the sales? What is the sales? How much can we recognize? How much can we recognize in this particular year? Can we recognize 100,000 as a whole as sales? No. Why? Because the performance obligation is not satisfied for the remaining 1 year warranty. So how much will we show? We'll show 90,000 exactly. We'll show 90,000. So what else is remaining? Is there anything else? Is there anything else? Is there anything else resulting as a result of this transaction? Exactly. There's a liability, right? So liability is increasing right here. So if liability increases, where will we show it? Will we show it on the debit side or the credit side? Debit or credit? Debit or credit? I want everyone's response. Debit or credit? Credit. So what will be on the credit side? Liability. How much? 10,000. Are you guys clear with this? Are you guys clear with this? I want everyone's response. Is it okay? Okay, okay. Fine, fine, fine. Shall we move on? So we have to learn in detail about all these 5 steps. Okay. We have to learn about all these steps. Okay. So let's start with identifying the contract. Okay. Identify contract. So there are certain criteria. Okay. There are certain criteria to be met in order to do what? In order to identify the contract. In that, the first one is both parties should approve. Okay, both parties should approve the contract. Okay, both parties should approve the contract. The second one we have is payment terms. Payment terms must be identified. Payment terms must be identified. The next one we have is the goods or services that has been mentioned in this contract. The goods or services, risks and rewards. Risks, see, this is very important line. Okay, risks and rewards. What is risks and rewards? It's the control of the goods, right? The control of the goods. Risks and rewards is meant. What is meant by risks and rewards? It's the control. Should be transferred to whom? Whenever we are getting into a contract, the risks and rewards should be transferred to whom? Should be transferred to whom? Should be transferred to whom? You want to tell me? Transfer to whom? Exactly. Should be transferred to the customer. Okay. So the fourth one is entity should be probable. Entity should be probable to collect what? To collect consideration from customer. These are the conditions in order to identify what? In order to identify what? Identify a contract. Is it clear? Shall we move on to the next one? Shall we move on to the next one? Okay, okay, fine, fine, fine. Next, what we have is identifying the performance obligations. I've already told you, performance obligations are what? Performance obligations are promises to transfer distinct goods or services to a customer. So, as we have seen, there might be more than one performance obligation in a contract. Okay. Is it clear? Is this clear? Is the performance obligation part clear? Okay, okay, okay. Fine, fine, fine. See, next what we have? Next, what do we have? We have determining the transaction price. Determining the, see, this is one of the most important topics of what? Revenue. Determining the transaction price. That is step 3. What is step 3? Determine the transaction price. Determine the transaction price. So, do you guys know what all are the different types of transaction price? Tell me. What all are the different types of transaction price? What are the different types of transaction prices? Can you guys recall what all are there? What all are they? See, have you guys heard of variable consideration? Have you guys heard of variable consideration? Variable consideration. Have you guys heard of variable consideration? What is it? This is a type of transaction price, right? It's a type of transaction price. What all are they? We have variable consideration. Variable consideration. What else do we have? What else do we have? There are four types of consideration. Do you guys recall anything? There were like four types of considerations. Do you guys recall? The second one is significant financing component. Significant financing component. What is the third one? Consideration payable to customer. Consideration payable to customer. And the fourth one we have is non-cash consideration. Do you guys recall anything of any of this? Non-cash consideration. Non-cash consideration. I want everyone's response. Have you guys learned this? Have you guys learned this? I want everyone's response. Where are the rest? You guys have learned this, right? Are you guys thorough with these topics? Are you guys thorough with these topics? About this consideration part? So you can tell honestly. No. But have you guys been taught this? It was taught, but you guys didn't understand it, right? Okay, okay, fine, fine, fine. Is it the same with everyone? Is it the same with everyone? Okay, 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 okay. So see, guys, don't worry. If you sit in this class properly, you'll be able to learn all these with proper examples. Okay. So first, what do we have? First, what do we have? We have variable consideration. We have variable consideration. We have variable consideration. So let me tell you what happens in a variable consideration. See, in the previous case, in the previous case, what was the consideration here paid by the customer? What was the consideration paid by the customer here? 100,000, right? Is it varying? Is it fixed? It's fixed, right? It's fixed, right? There is no change in this consideration, right? There is no change in this particular consideration because it's fixed. But coming on to this variable consideration, what happens here is that it won't be fixed. Okay. We cannot determine the consideration at the starting of the contract. I'll tell you with a proper example. Let's say we have a company. We have a company. We have a company. Let's say we are in contract with a company in order to construct a building. Okay. We are in contract with a company in order to construct a building. So what are we? We are a construction company. Okay. What are we? We are a construction company. Construction company. Okay. So let's say the contract was signed on 1st Jan 2020. The contract was signed on 1st Jan 2020. What was the contract for? It was for construction. It was for construction. Now tell me, what is the performance obligation here for a company? What is the performance obligation here for the A company? I want every one of you to respond. Yeah. Our performance obligation is to do what? Is to construct the building. Is everyone listening? I want everyone to respond. What is our performance obligation here? What is our performance obligation here? Our performance obligation is to construct the building. So let's say the contract price is 100 million, is equal to 100 million. Okay. And the contract term is for 3 years. Okay. So what is happening in this equation is that, see, let's say this is a Reliance company. Okay. This is Reliance. Okay. This is Reliance. So what Reliance company told us is that they told us that if construction is completed, within 2 years, within 2 years, they will pay us an additional consideration. What? Additional consideration of 20 million. Additional consideration of how much? 20 million. Are you guys following? So what happened here? We were in a contract with whom? With Reliance company in order to construct a building, right? We are a construction company and we are constructing a building for Reliance company. So what was the initially agreed contract price? It was 100 million. But there is a clause which states that if construction is completed within 2 years, they will pay us what? They will pay us how much? If the construction is completed within 2 years, how much will they pay us? Tell me. Everyone. Yeah, they'll pay us additional 20 million if the construction is completed within 2 years, right? Yeah, exactly. So let me tell you, what are the possible considerations that we can receive from this contract? What are the possible considerations that we can receive from this contract? What is the possible revenue that we can generate from this contract? It can either be 100 or it can be 120, right? It can either be 100 million or it can be 120 million. Is this concept clear? Is this clear, guys? I want everyone to respond. Is this clear? Everyone. Is this concept clear? Okay, fine. Okay, fine. So, is the consideration fixed in this case? As we have dealt with the previous case, is this fixed? Is this fixed? No, right? Why? Because it's a variable consideration. See, it can either be 100 million or it can either be 120 million. Is this clear? Okay. So let's move on to the next topic. Sorry, not next topic, next step. What is the next step? We have to recognize revenue, no? See, in the previous case, we sold a car, right? So when did we recognize revenue? Once the risks and rewards once the control of the car was transferred to the customer, right? We recognize revenue when our performance obligation was satisfied. What is our performance obligation here in this scenario? What is our performance obligation? What is our performance obligation? Construct, right? We have to construct a building. In the previous case, we were just transferring a good. That is what? Car. We were just transferring a car. So we can recognize revenue at that point of time, at that particular point of time. But here, how do we recognize revenue? How do we recognize revenue? Can we only recognize revenue after construction, or can we recognize revenue in between? Exactly. We'll recognize revenue over time. In the previous case, we recognize how? We recognize revenue at a particular point of time, right? Here, how do we recognize revenue? We'll recognize revenue over a period of time. So, let's say 20% of the construction is completed by the end of year one, by the end of year one. So now tell me, how will we calculate this revenue? How will we calculate revenue? Based on what? Based on what? Based on what? Yeah, exactly. We will recognize revenue based on its completion, based on the completion. So what will be the what is the consideration? That is actually that. What is a fixed consideration here? What is the fixed consideration here? What is the fixed consideration here? I want everyone to respond. What is the fixed consideration? See, no matter what, we'll anyway be receiving how much? 100 million, right? We are only unsure about what? We are only unsure about the 20 million, right? We are sure about the 100 million. We are not sure about which amount. We are not sure about only 20 million. Is it clear? Is it clear? Okay. So tell me, what will be the revenue? Revenue will be equal to how much? How much? 20 million. It's 100 million into 20%. Got it. Is this clear? Is this part clear? 100 million into 20 million. But let me tell you guys one thing. This is not the only revenue that we will recognize. This will not be the only revenue that we will be recognizing. You know why? Okay, now tell me. Now coming on to the question. See, we can see that we will be receiving an additional consideration provided the construction will be completed within 2 years, right? So we have to recognize a revenue based on this as well. So let's say the probability of completing this within 2 years is, let's say the probability is 30%. Chance of completion is, what is the chance of completion? 30%. We are only 30% sure that we will be able to complete what? We will be able to complete the construction within 2 years. Is this clear, guys? Is this so far clear? Is this so far clear? Okay. What is the chance of completing the project within 2 years? What is the chance of completing the project within 2 years? It's 30%, right? Okay. So coming on. How much have we completed? How much construction have we completed so far? 20%. So what we will do is, what is the additional consideration that they told us they will be providing us? Additional consideration. What is the additional consideration? 20 million, right? So we have 20 million here. This 20 million is for the whole construction of the building. How much have we completed so far? How much have we completed so far? 20%. So we'll multiply it with 20%. Got it. Is this clear? Is this clear, everyone? I want everyone's response. Is this clear? Is this clear? Okay. But are we sure about this? Are we sure that we will be completing this within 2 years? Are we sure? Are we 100% sure? So can we recognize this 100%? Can we recognize this whole 100%? No. We have to multiply it with what? We have to multiply it with the probability. What is the probability here? What is the chance of completion? How much is the chance of completion? 30%. So what should we do? We should multiply it with what? Should multiply it with 30%. Did you guys get this? Did you guys get this? Is this concept clear? I want everyone's response. I want everyone's response. I want everyone's response. Everyone. The whole 17 students also are sitting in the class. I want everyone's response. Is this concept clear? Is this 100% clear? If you have any single minute doubt, ask me. Don't hesitate to ask. Don't hesitate to ask any doubts. Okay. If this is not clear, it will affect your exam. If you have any minute doubt, just ask me. No doubts. Can I move on? Can I move on? Okay, fine. So what is the total revenue? What will be the total revenue in this case? What is 100 million into 20%? It's 20 million, right? Plus, how much is 20 million into 20% into 30%? Which is approximately 1.2 million, I guess. So the total revenue recognized will be 21.2 million. Is this clear, guys? You guys understand how we will be recording a variable consideration? How will we be recognizing revenue for a variable consideration? Is this clear? Is this clear, guys? It's clear, right? Can I move on to the next topic? See, everyone, is it clear? Okay, fine. So, do you find this difficult? Now, do you find this difficult? Do you find this variable consideration as difficult? Is it tough? Is this tough? It's easy, right? Okay, fine. So this is with variable consideration. This is how we recognize revenue with a variable consideration. So what next? We have financing component, right? The next consideration is financing component. Let's see what is financing component. Do you guys have any idea what is financing component consideration? Do you have any idea? Yes or no? Yes or no? Do you have any idea? Customer or entity? Okay. Do you guys have any idea about how we will treat a financing component? So, okay, I'll explain this. You need to get to know. So, as usual, we have a company, okay? We have a company. We have a company. And we have our customer. Okay. We have our customer. Okay. So, suppose a company is a furniture company. It's a furniture-based company. Okay. On 1st Jan 2020, what happened? We made a sale of 10 million to a customer. Okay. What customer told us is that the customer will pay after 2 years. After 2 years. So I want you guys to tell me what happened here. What happened here? We made a sale to whom? We made a sale to a customer for 10 million. See, are the risks and rewards being transferred here? Are the risks and rewards being transferred here? I want everyone to respond. Is the risks and rewards transferred here? Okay. So now tell me the journal entry for this. Tell me the journal entry. What is happening here? Journal entry. I want everyone to tell me the journal entry. Journal entry. What will be on the debit side and what will be on the credit side? Come on, tell me, guys. What is happening here? Exactly. Debit what? Debit what? Are we receiving any cash here? Are we receiving any cash here? No. Are we receiving any cash? No. So, how will we show a transaction? See, we are yet to receive cash. We will be receiving cash, but we have not received it. How will we show? How will we show in the books such situations? How will we show such situations? How will we show such situations? We are yet to receive cash, but we are not yet received. We have not yet received cash. So how will we show it? How will we show it? We will show it as receivables, right? We will show it as what? We will show it as receivables. Receivables. What about credit? What will be on the credit side? What will be on the credit side? What will be on the credit side? I want every one of you to respond. What will be on the credit side? It is nothing but sales. Are you guys good with this journal entry? Is it clear? Okay. Now, what is the amount that is yet to receive? What is the amount that is yet to receive from the customer? How much is the amount? How much is the amount? How much is the amount? Tell me. Everyone, I need everyone's response. 10 million, right? When will we get this 10 million? Will we get it today? Will we get it today? No. We'll be receiving it after 2 years, right? So we will be receiving 2 years after 2 years. I mean, we'll be receiving 10 million after 2 years. So anything to be considered here? Anything to be considered here? Exactly. Exactly what? We are receiving this 10 million after what? After 2 years. That is more than 1 year, right? Whatever we are going to receive after 1 year, we have to do what? We have to convert it into what? Convert it into present value, right? We have to convert it into present value. Are you guys clear with this? Are you guys clear with this? We have to convert this 10 million into present value. So let's say the discounting factor is given, that is 0.826 for 2 years. Discounting factor is 0.826. So what will be the sales? What will be the sales that we will be recognizing? What will be the sales that we will be recognizing? Tell me. How much will be the sales amount? 10 million into 0.826, right? 10 million into 0.826. That will be 8.26. How much will it be? 8.26 million. Is it clear? Is it clear, guys? Is it clear? I want everyone's response. Is it clear? Everyone. I want everyone's response. Is this clear? So what will be the sales amount that we will be recognizing here? It will be how much? It will be how much? How much will be the sales amount? How much will be the sales amount? It will be 8.26 million, right? What about receivable? Same with the receivables. How much will be recognizing sales? 8.26 million. Is this clear? Are we done with this? Is there anything else to be considered? Is there anything else to be considered? Is there anything else to be considered? What is it? What is it? What is it? Finance cost. Okay, now tell me, is this actually a finance cost for us? Is this actually finance cost? Are we incurring any expense here? Are we incurring any expense? No. This is an asset, right? What is receivable? Is it an asset or liability? Is it an asset or liability? Asset. Asset, right? Are you guys sure? It's an asset, right? Is it's asset, right? Yeah. Okay. So when will we incur finance cost? We will incur a finance cost on a liability, not on asset. Okay. So what is it in this case? So since it is an asset, what is the interest attributable on this asset will be for us? Will it be finance cost? It will be a finance income, right? We are receiving an interest on this asset. We are receiving this asset. We are receiving this income. So what is it? It's not finance cost, but it's finance. What is it? What is it? What is it? What is it? It's finance income. Got it. It's finance income. So what is our opening receivables? I want everyone to tell me. What is the opening receivables? On 1st Jan 2020, we made a sale. So what is the opening receivables? What is the opening of receivables? What is the opening of receivables? What is the opening receivables on 1st Jan 2020? Come on, guys, tell me. What is the opening of receivables? I want everyone to respond. How much is it? It's 8.26 million, right? 8.26 million. So let me ask you one thing. Will we show this opening of receivables in the FS statements? Will we show the opening value? Will we be showing the opening value? Will we show opening value or closed value? Closing value. Which one will we show? In the FS statements, while preparing the FS statements, will we show the opening value or the closing value of the receivables? We will show closing values, right? We will be showing closing value. What is the opening receivables here? It is 8.26 million. So what we have to do? What we should do? What we should do here? We have to convert this into closing value, right? In order to convert this into closing value, what should we do? Add finance income, right? Add what? Add finance income. Add finance income. How much is the finance income here? How much is the finance income? How will we calculate the finance income? How much will be the finance income? How will we calculate the finance income? We have converted this into present value. Let's say the discounting factor is 10%. Okay. How will we convert this into? How will we calculate this finance income? How will we calculate this finance income? 0.826, right? 0.826. How did we get this? 8.26 million multiplied by how much percentage? 10%. Got it. How much will it be? How much will it be? 0.826 million. Got it. So adding this, what will we get? We will get the closing of what? Closing of receivables. Closing value of receivables. What is it? How much is it? 9.086 million. Are you guys okay with this? Are you guys okay with this? We'll be showing how much? 9.086 million as what is the closing value of the receivables? It will be 9.086 million. Okay, fine. So now tell me, how will we treat this in the books? How will we treat this in the books? We have to prepare 2020 FS, right? At the end of the year, we have to prepare FS statements. So what will be shown in SOPL with respect to this transaction? What will be shown in SOPL? What will be shown in SOPL? Recognize revenue of how much? Revenue of how much? Recognize revenue of 9.086 million. Got it. Recognize how much? No, the revenue is actually 8.26 million, right? Not 9.086, it's 8.26. Is this clear, guys? Is this clear? Is this clear? How much is the revenue? 8.26 million, right? See, we have calculated the revenue here. What is the revenue? 8.26 million. So anything else in SOPL? Is there anything else that we have to consider in SOPL? Is there anything else that we have to consider? Is there anything else that we have to consider? Exactly. We have to consider what? We have to consider finance income, right? What is the finance income here? What is the finance income here? What is the finance income? How much is the finance income? It's 0.826, right? It is 0.826 million. Okay, fine. So coming on to the next, what do we have? We have SOFP. What will be showing SOFP? What will be showing SOFP? What will be showing SOFP? I want every one of you to respond. What will be showing SOFP? Exactly. What will be the value of receivables? What will be the value of receivables? What will be the value of receivables? What will be the value of the receivables? Tell me. What is the value? What is the value? Is it 10 million? No, it's not 10 million. It's 9.086 million, right? We found it out. What is the closing value of receivables? 9.086 million. This is how we prepare the FS for 2020 FS. Are you guys clear with this? Are you guys clear with this? Are you guys clear with this? I need everyone's response. I need everyone's response. Is this clear? Okay, fine. Okay, fine. So we are done with 2020, right? When are we receiving cash? We'll be receiving after 2 years, right? So what about 2021? What about 2021? 2021. See, in 2021, what is the opening receivables? That is on 1st Jan 2021. What is the opening of receivables? What is the opening of receivables? Tell me. I want everyone of you to respond. What is the opening of receivables? See, the opening of receivables of 1 year will be the closing value of the receivables in the previous year. What is the closing value of the previous year? It's 9.086. So what is the opening of receivables in the 2021? It will be 9.086 million. You guys have any doubt? Any doubt in this? Any doubt in arriving at this figure? Okay. So do we show opening value in while preparing 2021 FS? Will we show the opening value? Will we be showing opening value? No. We have to convert it into what? We have to convert it into what? We have to convert it into closing value. How do we calculate? How do we convert it into closing value? How do we convert? Finance income. Yeah, exactly. We have to add what? We have to add finance income. How much will be the finance income? How much will be the finance income? It will be 0.9086 million. So what will be the closing receivables? Will be approximately equal to how much? 10 million. The closing of receivables will be equal to 10 million. So I want you guys to tell me how will we show this in the FS? 2021 FS. How will we show this transaction? How will we show this transaction in 2021 FS? What will be there in SOPL? Will there be anything in SOPL? Will there be anything in SOPL? Is it finance cost? Okay, guys, listen. See, we have already recognized revenue. So is there a need to recognize revenue now? Is there a need to recognize revenue again? See, okay, let me tell you guys one thing. If we recognize revenue, what will happen? You're telling me we'll recognize 10 million revenue, right? So you're telling me we'll be recognizing revenue of 10 million. Okay. So how much did we recognize in the previous year? How much did we recognize in the previous year? How much did we recognize? 8.26 million. So in respective of this contract, you are recognizing how much in the books? How much are you recognizing in the books? You are recognizing 18.26 million as revenue, right? In total. Is that the case here? We are only recognizing this revenue, right? Did you guys get it? Did you guys get it? Yeah, we will only be recognizing what? See, we have already recognized revenue. We have already recognized revenue by converting it into present value. So it's over. It's over in 2020 FS. Now coming on to 2021, we'll only recognize finance income under what? Under what? Under SOPL. Do you guys get it? Any doubts? Any doubts? Will we show revenue in the second year also? Will we be showing revenue in the second year also? Will we show? Will we show revenue? I want everyone's response. Will we be showing revenue? Will we show revenue in second year? No, right? Why? Because we have already recognized revenue in the previous year. So we will not be showing what revenue. What is the finance income here? It's 0.9086, right? Okay. What about SOFP? Is there anything in SOFP? Is there anything in SOFP? Is it cash? See, first of all, we won't be showing cash in financial statements, okay? If you are receiving cash, we won't be showing it in finance statement. See, you can see in the previous scenario, did we show any cash in FS statement? Did we show any cash in FS statements? See, you can see the, yeah. See, what is the closing value of receivables? 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 10 million. It is 10 million. But there is one more thing to consider here. If we receive cash at the end of the year, will we show this 10 million here? Will we show this 10 million if we have received cash? If we received this amount, will we show this receivables as an asset? Will we show this receivables as an asset if we receive this cash from the customer? No, right? Why? Because we received cash. See, so therefore, if we receive cash, what will happen? We have to de-recognize it from the books. De-recognize if cash is received. If cash is received. Did you guys get it? Is this clear? Is this clear? Now tell me what will be the journal entry? What will be the journal entry if the cash is received from the customer? Tell me the journal entry if the cash is received from the customer. Yeah, it is debit cash. How much is the cash? How much is the cash that we are receiving? How much is the cash? How much is the cash? 10 million. So as part of receiving cash, what should we de-recognize? What should we de-recognize? We should de-recognize receivables. How much will be the receivable? Will be 10 million. Is this clear, guys? Is this 100% clear? Is this 100% clear? I want everyone's response. I want everyone's response. Is this tough? Is this tough? Is this tough? Okay, okay, fine, fine, fine. So shall we move on to the next consideration, next type of consideration? Can we move on to the next type of consideration? Is this clear so far? Okay, okay, fine, 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 fine. Yeah, it is time consuming. Yeah, exactly. See, but it's not that time because you're telling me in perspective of the exam. Are you telling me in perspective of exam? What did you mean? What did you mean by it is time consuming? Tejas, am I audible? On what perspective did you tell it is time consuming? Not explain line by line. Yeah, exactly, exactly. See, you should have some sort of benefits from this revision class, right? I'm explaining this line by line because you guys are finding it difficult for IFRS 50. That's the reason. So what should I do? What should I do now? Tell me what should I do? What should I do? See, you guys have to get some sort of benefit right from this class. If I explain everything randomly, you won't be able to. So Tejas, are you good with IFRS 15? Are you clear with the concepts? Let's start with non. See, we'll try to cover it as fast as possible. See, we have non-cash consideration. Okay. We have non-cash consideration. We have non-cash consideration. So let's say we have a company. Let's say we have a company and we have what? We have a customer, or let's say we have another company here. Tata. Okay. So what? So let's say a company sold 10 trucks. Okay. Sold 10 trucks. To who? To Tata company on 1st Jan 2020. 1st Jan 2020. So in return, what did Tata do? Tata company, Tata company issued 10,000 shares. Issued 10,000 shares in return. So this is a cash consideration. Is this a cash consideration? Is this a cash consideration? Tell me, guys. Is this a cash consideration? No, right? It's not a cash consideration. Why? Because we are receiving consideration in the form of shares, right? So let's say on 1st Jan, on 1st Jan 2020, on 31st December 2020, the share price of one share of Tata is $5, and the share price at the end of the year is $5. So tell me, what will be the journal entry for this transaction on 1st Jan 2020? What will be the journal entry? What will be the journal entry for this transaction? What will be the journal entry for this transaction? What will be on the debit side and what will be on the credit side? Tell me, guys. If you respond fastly, we can move on. Any idea? See, on the debit side, what is happening? We are selling trucks, right? So what is it? It's sales, right? It's sales. Is it clear? It's sales, right? So what on the debit side? What are we receiving in respective of this shares? Meaning in respective of this sales, what are we receiving? We are receiving shares, right? We are receiving shares. So how do we record shares? We record shares as financial asset. Okay. We'll record shares as financial. So how much is the amount? How much is the sales that is happening here on 1st Jan 2020? What will be the amount? It will be 50,000, right? It will be 50,000. How did we get this 50,000? How much shares did we receive? We received 10,000 shares. What is the price of the shares at 1st Jan 2020? It's $5. So 10,000 into 5, that is 50K, right? So we'll be showing 50,000 in sale and same as what? Here. Is this clear? Is this journal entry clear? Okay, fine. So we will prepare what? 2020 FS at the end of the year. So what will we be showing into SOPL? What will be showing SOPL? What will be showing SOPL? I want you guys to respond fastly so that I can move on. I can increase my pace. Tell me what will be showing SOPL? What will be showing SOPL? We will show sales, right? We will show sales, right? How much is the sales? It's 50,000. It's 50,000, right? Is there anything else that we will show here? See, let me tell you guys one thing. See, this is a financial asset, so its value keeps on changing, right? What is the closing? This is the opening value of financial asset is how much? What is the opening value of financial asset? What is the opening value of financial asset? I want every one of you to respond. How much is it? How much is this? It's 50,000, right? But will we show the opening amounts in the FS statements? Will we show the opening amounts in FS statements? No. No, right? We'll convert this into closing amount. So how will we transfer this financial asset in its closing amount? What will it be? What will the closing amount be for this financial asset? What will it be? How much will be the financial asset? Oh, sorry. Sorry, guys. This is not 5. Okay, this is 3. What will be the closing amount of financial asset? See? Yeah, exactly. It will be 30,000, right? It will be how much? It will be 30,000. So, opening value was 50,000. Closing amount was 30,000. So, what does that mean? What does that mean? What does that mean? Opening amount was 50,000, but in the closing it was only 30,000. What does that mean? It means that there has been a loss, right? There has been a loss. Loss on financial asset. How much? How much is the loss? It's 20,000, right? 20,000. So in SOFP, what will we show? What will we be showing in SOFP? We'll show financial asset. We'll be showing financial asset. What is the value of the financial asset? What will be the value of financial asset? 30,000. Is this clear, guys? Is this clear? Not everyone of it to respond. Is this clear? Okay, okay, perfect. So that's it with the third type of consideration, that is non-cash consideration. Okay. See, I want you to tell me, do you want me to continue like this, or what do you guys want? How do you want the revision to be? Do you want me to continue like this? Do you want me to continue like this? Okay, okay, fine. Okay. So the next one is, so you guys do one thing, be back by 5:40. Okay. Be back by 5:40. Be back by 5:40. So are you guys back? Shall we start? Shall we continue? Wait, wait. So far, we have discussed what? We have discussed the types of considerations. Okay. Now, let's move on to the last consideration type of consideration, that is consideration. Consideration payable to customer. Consideration payable to customer. So what do we have in this regard? We have A company. Let's say we have A company. And A company is a construction company. A company is a construction company. And they are constructing a building. Okay. So on 1st Jan 2020, the contract was signed and the condition was to construct it within 3 years. The contract price was, contract price is equal to 100 million. It's equal to 100 million. The contract was for 3 years. But there is a condition. What is the condition? What is the condition? See, if obligation, if obligation not completed, not completed within 3 years, what should we do? We should pay a penalty of penalty is equal to 10. So what is in this case? In this case, we are getting into a contract. We are getting into a contract with the customer in order to construct a building. And if the contract specifies that we will be completing this construction within 3 years. But what if we not complete this construction within 3 years? We'll have to pay a penalty. Is the scenario clear, guys? Is the scenario clear? Okay. So how will we treat this penalty? So there are two cases, okay? There are two cases. If consideration is paid to the customer in exchange of goods or services, then it should be accounted for as a purchase transaction. See, here there are two cases. If consideration is paid to customer not in exchange for a distinct good. See, if the consideration is paid to customer in exchange of goods or service, what is the service that we are providing here? What is the service that we are providing here? Are we providing any goods here? Are we providing a goods or service here? Tell me, I want everyone to respond. Is it a good? Are we transferring any goods or are we providing any service? It's a service, right? It's a service. So if the consideration, that is, if the penalty is being paid on behalf of not completing this asset within 3 years, which is directly attributable to the what? Due to the construction. That is, let's say we were facing some shortage in what? Let's suppose we were facing some shortage in what? Shortage in some materials or we were not able to purchase some materials, how will we show this penalty? We will show this penalty as what? We have SOPL, right? There are two cases. The first case is if the consideration, that is the penalty, is paid to customer in exchange for the service that we are providing. That is, we were not able to complete this within 3 years because let's say the material was not available. It's purely related to the service, right? So in that cases, what we'll show is in SOPL, we will recognize what? Revenue. What will be the revenue? 100 million. See, the revenue will be 100 million. And the penalty will be shown as a purchase transaction. Will be shown as a purchase. How much is the penalty that we are paying? How much is the penalty that we are paying? How much is the penalty that we are paying here? 10 million. So it will be shown as 10 million. Got it. If the penalty is paid, if the penalty is paid on behalf of this construction, that is attributable directly to the construction. Okay, you guys get it? We'll show this as purchase transaction. We have second case. What is the second case? In the second case, if the penalty is paid to the customer, not in exchange for the service that we are providing, not in exchange with the service that we are providing. For example, let's say illegal contract. Okay, if we are doing an illegal contract, what we have to do? We cannot show what? We cannot show revenue fully. Okay. In this case, what happened? We were facing shortage of materials. Okay. See, we were facing shortage of materials so that we couldn't complete the construction. Is this directly attributable to the construction? The shortage of materials. Is this directly attributable to the contract? Yes, right? So what we will do in such cases? We will recognize the revenue fully. What is the revenue here? 100 million. And the consideration that we have paid to the customer will be shown as what? Will be shown as purchase in the SOPL. Got it. Now, in the second case, let's say the penalty that we are paying is not directly attributable to the construction. Okay. It was related to something else. Okay. We were doing an illegal, so let's suppose we are doing an illegal contract. So in such cases, if the reason for the payment of this consideration to the customer was not attributable directly to the service, how will we show? In SOPL, we will show what? We will only show revenue of 90 million. We will only show revenue of 90 million. How is it 90 million? We deducted this penalty. We deducted this penalty from the revenue and we will only be showing what? Revenue of 90 million. Is this clear, guys? In the first case, we showed it as a purchase transaction since it was directly attributable to what? Directly attributable to the construction. In the second case, we are paying penalty not in relation to the construction. We were involved in some illegal contract and we got caught or something else. And we were not able to do what? We were not able to complete the construction within 3 years. In such cases, what we will do? In such cases, we will reduce this penalty from our revenue. What was supposed to be our total revenue? It was supposed to be 100 million. But due to illegal contract, we had to pay a penalty of 10 million. Right. So what will be the revenue that we will be recognizing in the books? It will be 90 million in the second case. Is this clear? Is this clear, guys? If you build within 3 years, what is the effect? See, if we build within 3 years, it will be the same as we did in what? We will have to recognize full revenue of 100 million. Got it? Got it. See, there is no need to pay the customer, right? We will only be paying customer in case the construction is not completed within 3 years. Got it. A consideration payable to customer arises when the condition is not met. Here, if you are completing this transaction within 3 years, we are meeting the condition, no? So is there a need to pay consideration to the customer? No, right? So that's it with what? Consideration payable to customer. Okay. Now we are moving to the next step. What is the next step? We have step 4. What is step 4? Allocation of what? Do you guys know how to allocate transaction prices to performance obligation? Or should I, is there a need to explain it? Tell me. Should I explain the allocation of transaction price? Or do you guys know it? Should I explain? Tell me, everyone. Tell me in the chat box. Do you guys know how to allocate transaction price? Everyone, I need everyone's response so that I can do it accordingly. Do you want me to explain the allocation of transaction price to performance obligations? I want everyone's response. See, there are almost 18 participants. Do you want me to explain? Okay. Then I'll just explain it as fast as possible. See, listen, okay. See, there is a company, and there is a customer, okay. What we did, we sold a car. This, as I said, we sold car with 2 years validity. With 2 years warranty. 2 years warranty. So what was the price? The contract price was $100,000. $100,000. We sold the car with 2 years warranty for 100,000. So what is step for? Say we have to allocate, right? Allocation of what? Allocate transaction price. See, how much performance obligation do we have here? Do we have only one performance obligation? How much performance obligation do we have in this case? How much performance obligation do we have? We have two performance obligations, right? One is to sell the car and the other one is to provide warranty. So in the question, standalone prices of the car and warranty will be given. Okay, let's say the standalone price. Standalone price car is equal to $100,000 warranty. 2 years warranty is equal to $40,000. So what is the total standalone price here of car and warranty? What is the total price? What is the total price? What is the total standalone price? It is 140,000. It is 140,000. It is 140,000. The standalone price is 140,000. But for how much are we giving this to the customer? For how much price are we giving this to the customer? Yeah, we are giving it at a discounted price, right? We are giving it for 100,000. So we need to allocate this price, this 100,000 to car and as well as warranty based on this standalone price. Got it? Got it, guys. We have to allocate the transaction price to car and warranty based on this standalone price. Okay. Is it clear? Is it clear, guys? Okay, fine. Okay, so how do we allocate? So let's take the case of car. What will be the price allocated to car? Let's see. Price allocated to car. Allocated to car will be equal to how much? You guys have any idea? Yeah, exactly. Car will be 79 and the rest will go to 20. And the rest 29 will go to service. So how is the formula? See, what is the total? What is the price for which we are giving this contract? What is the contract price here? Yeah, we'll have to calculate it based on pro rata, right? So what is the contract price here? What is the contract price? What is the contract price? Tell me. What is the contract price here? It's 100,000. So for car, we'll allocate, we have to allocate how much amount? We have to allocate this 100,000, right? Into What is the standalone price of the car? What is the standalone price of the car? I want every one of you to respond. What is the standalone price of the car? 100,000, right? So we have 100,000 here. We have 100,000. What is the total standalone price? What is the total standalone price? Total standalone price. It is 140. It is 140,000. So what is it? It will be almost equal to 7142. Okay. So I want you guys to know what is the price allocated. Price allocated to what? Price allocated to 2 years warranty. 2 years warranty. How much will it be? What will be the formula? Yeah. It will be 100,000 divided by 100,000 into what is standalone price? 40,000. In divided by how much? 140,000. So what will it be? It will be the remaining amount, that is 20, approximately 29,000. That will be 28,571. 28,571. Is this clear, guys? Will be 28,571. So now tell me how much revenue will be recognized at the end of the year. In 2020 FS, in 2020 FS, in SOPL, how much revenue will be recognized? How much revenue will be recognized? What is the revenue that we will be recognizing? How much will be the revenue that we will be recognizing? Exactly. It will be how much? Revenue will be, what is the revenue for the car? It is 71,428, right? 71,428 plus. What is it for warranty? Will we show this 2 years warranty as a whole? Will we show this 2 years warranty as a whole? No. We'll only show 1 year's warranty, right? 1 year's warranty. How much is it? It's approximately 14,285. This is approximately equal to 85,713. 85,713. What about SOFT? What about SOFT? Will we show anything in SOFT? Exactly. We'll be showing the remaining amount that we have received. We have received 100,000 and we have recognized only 85,713. So what will be the remaining liability? We will show this as deferred liability. Okay. We will show this as deferred liability under liability as how much? The remaining amount is 14,285. Is this clear, guys? Is this clear? See, they will give the standalone price. Don't worry. They will give us the standalone price. Okay. In the question, it will be mentioned. Okay, fine. So we are done with the 5-step model. Okay. Are you guys having any doubts? Any minute doubts, you can ask me. Do you guys have any minute doubt? See, I want everyone's response. Tell me. Okay. Now we are moving to the toughest part in revenue. Okay. What is it? It's revenue recognition. Do you guys know how to recognize revenue? On what basis? Revenue recognition. How do we recognize revenue? Yeah, that is input and output method. Does everyone know this input and output method? Does everyone know this input and output method? So is there a need for me to take this? See, how will we calculate? We'll calculate it based on the cost that we have incurred so far. No, right? So shall we move on? So guys, now tell me, are you guys okay with revenue? Are you guys confident with revenue? Are you guys confident with revenue? Are all the doubts cleared now? Is it okay? Are you guys 100% confident with revenue? Okay, fine. You guys are good with revenue, right? What about IFRS 9? So what I'm planning is I'll just go through IFRS 9 right now. I'll just explain. So if you have any doubts, just tell me, okay? If you have any doubts, just tell me. So I'll just give a summary about IFRS 9. See, we're almost done with revenue. Are you guys feeling confident with revenue now? It's okay, right? Okay, fine, fine. So let's start with IFRS. And this is also one of the most important topic in what? In FR. Okay. I will give you a summary. So we have two types of financial instruments. What are they? Financial instruments. We have two types of financial instruments. What are they? No, it's not. No. See, it's debt instrument. It's debt instrument and equity instrument. No, yeah, it's debt instrument and equity. And equity. Okay. So there are two types of instruments, that is debt instrument and what? Debt instrument and what? Equity instrument. Okay. So now tell me what all are the components in a debt instrument? We have what? We have we have what? What do we have in debt instrument? Two components are there in debt instrument. What are they? Financial asset, financial asset and financial liability, right? Financial liability. What about equity instrument? What about equity instrument? Tell me. What about equity instrument? Yeah, we'll be having what? We'll be having financial asset and equity instrument and equity. So, so now let me explain you the methods. The methods for recording debt instrument. What all are the methods? What all are the methods in order to record debt instrument? What all methods do we use? What all methods do we use? There are three methods. What all are they? I'm talking about financial asset. Okay. I'm talking about financial asset. For financial assets, for financial assets, we have we have what? Three methods. How do we record? How do we show this in book? Yeah, that is amortized. Amortized, and then what? Fair value through OCI and fair value through P&L. Fair value through P&L. What about financial liability? What about financial liability? What about financial liability? How much methods are there? How much methods are there for financial liability? How much methods are there for financial liability? How much methods are there for financial liability? Don't you guys recall? There is only one method, right? That is amortized method. There is only one method for financial liability, that is amortized method. So now tell me, when do we use amortized method? Come on, fast. Come on, quick, quick. Come on, guys, tell me, tell me. When do we use amortized method? When do we use amortized method? We'll use amortized method when our intention is to hold what? Hold the financial asset. Do you guys get it? Is it clear? Is it clear, guys? Is it clear for everyone? I need everyone's response. When do we use amortized method? We use amortized method when our intention is to hold the financial asset. What about fair value through OCI? When will we use fair value through OCI? We'll use fair value through OCI when our intention is to hold, but may sell if better opportunity arises. In that case, how will we show it? We'll record financial asset under fair value through OCI. What about fair value through P&L? I want everyone to respond. When will we use fair value through P&L? When will we use fair value through P&L? Yeah, if the financial asset is bought for trading purposes. Got it. When the financial asset is bought for trading purposes, we will use fair value through P&L. Okay. So what about equity instrument? What about equity instrument? What all are the methods? What all are the methods that we use in equity instrument? Tell me. Yeah, exactly. It's only what? It's only fair value through OCI and fair value through P&L. See, the intention is same here. If it's bought for holding and selling it later, what is the method that we'll use? We'll use fair value through OCI. And if it's bought for trading purposes, we'll use what? We'll use fair value through P&L. Is this clear? Do you guys want me to explain how this will be recorded in the books? How will we calculate? Or are you guys clear with this? Do you guys know how to treat it in the books? Everyone, I need everyone's response. Okay, fine. So okay, let me ask you one question. How do we recognize? See, if it's a financial asset, what all things will be shown in SOPL? If it's a financial asset, what all things will be shown in SOPL? What will be shown in SOPL? If it's a financial asset, what will be shown? Is it finance cost? Is it finance cost? Income, right? See, on financial asset, we'll be incurring income, not expense, not a cost. Okay. It's not cost. On what basis do we calculate this finance income? On which rate? On which rate do we calculate this finance income? Tell me. See, almost every question, there will be two interest rates given, right? Yeah. We'll use what? We'll use effective interest rate. The finance income will be calculated using what? Effective interest rate. Is that clear? Is that clear, guys? Okay, fine. So let me ask you one thing. What about fair value through P&L? What is the interest rate that we'll use for fair value through P&L? What will be the interest rate that we will be using for P&L? Is it effective interest rate or normal interest rate? Is it effective interest rate or normal interest rate for fair value through P&L? Tell me, how will you calculate finance income? How will you calculate finance income? We want everyone's response. Come on. We will use interest rate for what? Fair value through P&L. Okay. We won't be using effective interest rate to calculate finance income, but rather we'll be using which value? We'll be using interest rate. Did you guys get it? We'll use what? Finance income. Here, finance income will be calculated based on interest rate and not effective interest rate. Got it? Is it clear? Is it clear, guys? Can everyone respond? Is it clear? For fair value through P&L model, we won't be using what? Effective interest rate. We'll be using interest rate. Is that clear? Okay, fine. So there's nothing much in finance instrument apart from this. And do you guys know impairment? Are you guys okay with impairment? Impairment of financial instruments. Okay. So let me ask you guys one thing. Uh, how much stages of risk do we have? How much stages of risk do we have regarding financial instruments? That is regarding financial asset. How much stages do we have? How much stages of risk do we have? Do you guys know we have stage one, right? We have stage one risk, stage two, stage three. If credit risk is low, we are at which stage? If the credit risk is low, we are at which stage? If the credit risk is low for the financial asset, we are at which stage? Do you guys know it? We are at stage one if the credit risk is low. What happens if credit risk is low? What should we recognize? What should we recognize if the credit risk is low? We should recognize what? A 12-month expected credit loss. Do you guys get it? If the credit risk is low, we have to create a loss allowance equal to how much? Equal to 12 months expected credit loss. Is that clear? Is that clear, everyone? Don't you guys have this credit? How did you study credit risk? I mean, impairment. You guys are not aware of stage one, stage two, and stage three? Oh, I guess then it won't be there in the syllabus. Okay, fine. Leave it. Okay, leave it. Won't be there. Okay. So yeah, that's it with financial instruments. There's nothing more. I guess impairment comes under SBR system. Okay. So it is learned in depth in SBR, not in FR. Okay. Yeah. So that's almost done with IFRS 9. Okay. Are you guys good with sale and lease back? Are you guys good with sale and lease back? This is also an important topic for FR. Are you guys good with sale and lease back? Is there sale and lease back for you guys? Under lease, are you guys learning sale and lease back? Yeah. So are you guys clear with this? Clear with that regarding sale and lease back? Are you guys good with the concepts? Are you guys good with sale and lease back? Do you want me to take it? It's also an important topic. Are you guys good with sale and lease back? Should I take it? Tell me. Should I take it? ROU is a bit confusing. So do you want me to explain it? Everyone, tell me. Do you want me to explain sale and lease back? Okay, fine. Okay. So listen properly, okay? See, you won't be confused anymore regarding ROU. Just listen carefully. We are going to take what? Sale and lease back. I hope you guys are good with leases, right? You guys are good with leases, right? You guys are good with leases, right? Okay, fine. So we have sale and lease back. We have what? Sale and lease back. So let's say a company, and there is what? There is B. So what is happening between A company? A company, A company sold a machine. Okay, A company sold sold a machine. Sold a machine to who? To B company. A company sold a machine to B company as per meeting the conditions of IFRS. What is the major condition of IFRS 15? What is the major condition of IFRS 15? In order to recognize a sale, what should we do? We should transfer the risks and rewards, right? Okay, let's suppose the risks and rewards of this risks and rewards have been transferred to whom? To B company. Transferred to B company. So, are they meeting the IFRS 15 criteria here? They are meeting the IFRS 15 criteria, right? That is, the risks and rewards have been transferred to B company. So, what did B company do here? B company leased it back to what? To A company. This is the scenario. You guys get it? Are you guys okay with the scenario? So what happened here? A company sold its machine to B company and B company leased it back to A company. Got it? Is this clear? Is this clear, guys? I want everyone's response. Is this clear? Okay, fine. So now I want you guys to tell me the journal entry for this, okay? So what is happening here? We are selling the machine, right? Now tell me, who is A company here? Who is A company here? Who is A company here? Is A company lessee or lesser? Is A company the lesser or lessee? Tell me. It's the A company is the lessee, right? Who is lessee? Lessee is an entity who 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 is lessee? Lessee is the entity who takes an asset for lease, right? Okay, so what is B company here? Who is B company here? Who is B company here? B company. So, in the books of, let's see, I want you guys to tell me what all things are happening here. At first, what happened? At first, what happened? At first, what happened? We sold the machine, right? We sold the machine. So as a result of selling this machine, listen properly. As a result of selling this machine, what will we be receiving? What will we be receiving as a result of this sale? We'll be receiving cash. So first entry, debit cash. Debit cash. Is it clear? We'll be receiving cash as part of the sale, right? We'll be receiving cash, right? So debit cash. So what is the second event that is happening here? Second event. What is the second event? What is the second event that is happening here? Lease, right? The second event that is happening here is lease. So whenever we are leasing an asset, what are the two entries that will come into our books? What are the two things that will come into our books? What are the two things? ROU and what? ROU and lease liability. Is that clear? Two things will come into our books, that is ROU and lease liability. What is ROU? Is it an asset or liability? Is it an asset or liability? Is ROU an asset or liability? So ROU is coming into our books, right? ROU is coming into our books. So what is happening? Asset is increasing, right? So we'll debit or credit right of use ROU. Will we debit or credit ROU? We will debit ROU. We will debit ROU. So now tell me the credit part. Why did we receive cash? Why did we receive cash? Why did we receive cash? I want everyone to respond. Why did we receive cash? Why did we receive cash? Is it because of lease? No. It's not because of lease. It's because of sale, right? It's because of sale. Is it clear? It's because of sale. So what will be on the credit side? If a sale happens, what should we show in the credit side? We should show credit what? Sale. Got it. It's actually not sale, it's actually machine. What are we de-recognizing? We should re-recognize machine, right? Machine. Is it clear? We are receiving cash as a result of de-recognizing our machine, right? We are selling our machine. Is it clear, guys? I want every one of you to respond. Is it clear? Okay. So in respect of ROU, what will be on the credit side? What on the for the cash, it is machine. For ROU, what will it be? It will be lease liability. It will be lease liability. Right. It will be lease liability. So this is with what? This is the journal entry for what? This is the journal entry for sale and lease back. Is this journal entry clear? Is this journal entry clear, guys? I want every one of you to respond. Is this journal entry clear? So there's one more thing. If there is a debit or credit balance, we'll show it as gain or loss on disposal. Loss on disposal. What will this be? This will be the balancing figure. Balancing figure. Are you guys good with this journal entry? I want every one of you to respond. We can only move on further if you understand this journal entry. Everyone in the session. Everyone. Is it clear? Is it clear? Okay, okay, okay. Fine, fine, fine. So this is how we do what? This is how we record a sale and leaseback transaction. Now I'll get you one question. Okay, I'll explain you with this with a question, so it will be better for you guys. Just hold on for a minute. Let me get the question. Just a minute. Guys, just hold on. Just hold on. Can you guys say this question? Can you guys say this question? Is it visible? Okay. So I'll solve it for you guys. So now tell me what is happening here. Painting sells an item of machinery to collage for its fair value of $3 million. So what is happening? Painting company sold a machine to collage company for how much? How much is the amount? For how much did painting company sell this? Sell this machine? How much did this painting sell? Yeah, it it sold the machinery for 3 million. So what are we getting here? What are we getting here? What are we getting here? We are receiving cash. How much? How much is the cash that we are receiving? How much is the cash that we are receiving? How much is the cash that we are receiving? How much is the cash? It's 3 million, right? It's 3 million. So as part of receiving this cash, what are we what are we losing as a result of receiving this cash? What are we losing as a result of receiving this cash? For what are we receiving this cash? For what purpose are we receiving this cash? For what purpose? Exactly, for disposing our machinery, right? See, whenever we de-recognize a machine, it at what value will we de-recognize it? What is the machine's value here? What is the machine's value here? What will be the machine's value here on the credit side? Will it be 3 million? It's a fair value, right? It's a fair value. See, remember this step. See, make a note of this statement. Whenever we are de-recognizing an asset from our books, we will de-recognize it based on our carrying amount of the asset. Okay. Whenever we are de-recognizing an asset, whenever we are de-recognizing an asset from our books, we will de-recognize it based on its carrying amount. And whenever we are acquiring an asset, what happens? We will recognize it based on its fair value. So what are we doing here with this machine? We are de-recognizing machine. So whenever we are de-recognizing an asset, we will de-recognize it based on its carrying value. What is the carrying value here? What is the carrying amount of the machinery here? I want everyone to respond. What is the carrying amount of the asset? Exactly. It's what? It's 1.2 million. So credit what? Credit what? Machine. Machine how much? 1.2 million. Is this clear, guys? Is this clear? Is this clear so far? Okay, fine. So what is happening next? The sale represents the satisfaction of a performance obligation in accordance with IFRS 15 of contracts with customers. Painting enters into a contract with Collage for the right to use of the asset for the next 5 years. So what is happening? What is happening, guys? What is happening? What kind of contract is it? What is the second? What is the contract? What type of contract is it? What type of contract is this? What kind of contract is this? It is a sale and leaseback contract, right? This is a sale and leaseback contract. It is a sale and leaseback contract. So the second contract is a lease contract, right? The second one in which we are involving is a lease contract. So for a lease contract, there are two things I told you that we will recognize. What all are they? What all are they? What is the two things that we will be recognizing? What will be the two things that we'll be recognizing? I want everyone to respond. ROU and what? ROU and lease liability. So where will we show this ROU? Where will we show this ROU? Where will we show this ROU? We will show this ROU on the debit side. ROU. What about the lease liability? Where will we show this lease liability? We'll show it under the credit part. What is it? Lease liability. Lease liability. What is the lease liability? Can you guys tell me what is the lease liability here? Can you guys tell me what is the lease liability in this case? In this question, what is the lease liability? What is the opening lease liability? What is the opening lease liability? 1.9 million, right? See, you can see the present value of annual lease payments is how much? The present value of annual lease payment is how much? It is 1.9 million, right? So what is the value of lease liability? What is the value of lease liability? It is 1.9 million. 1.9 million. What about ROU? See, listen carefully, okay? Listen carefully. In the case of a normal lease, ROU and lease liability will be same, no? In a normal lease, ROU and lease liability will be same. Am I correct or wrong? In the case of a normal lease, ROU and lease liability, opening ROU and opening lease liability will be same, right? But in a sale and lease contract, in a sale and lease back contract, will ROU and lease liability be same? Will it be same? Will ROU and lease liability be same? No. We have a formula to calculate ROU. Okay. We have a formula to calculate what? ROU. So listen carefully. How do we calculate ROU? ROU is equal to what? Carrying amount. The carrying amount of the asset into present value of these payments. Present value of lease payments. Present value of these payments divided by what? Divided by fair value. Fair value of the asset. Fair value of the asset. Now read this question. Read this question and tell me what is the carrying amount of the asset. What is the carrying amount of the asset? Tell me what is the carrying amount of the asset. What is the carrying amount of the asset? Everyone, what is the carrying amount of the asset? What is the carrying amount of the asset? I want every one of you to respond. How much is it? It's 1.2 million, right? It is 1.2 1.2 million. What about the present value of lease payments? What is the present value of lease payments? What is the present value of lease payments, guys? Come on, tell me. What is the present value of lease payments? Exactly. It's 1.9 million. What is the fair value of these payments? Sorry, what is the fair value of the asset? What is the fair value of the asset? It is 3 million. Calculate approximately equal to how much? Will be equal to 0.76. Is this clear, guys? Are your confusions regarding ROU over? How much is the value of the ROU? How much is the value of ROU? How much is the value of everyone to respond? How much is it? How much is it? How much is the value? 0.76 million. 0.76 million. Now tell me, is there any adjustment that we have to make? There is a gain, right? Gain on what? Gain on disposal of machine. How do we calculate? How do we calculate this gain? Based on balancing figure, right? Based on balancing figure. So now tell me, what is the total of, what is the total on the debit side? What is the total figure on the debit side? How much is this equal to? Cash and ROU. How much is the total? 3.76 million, right? What about the credit side? Sorry, what about the credit side? What about the credit side? What about the credit side? It's 3.1 million. It's 3.1 million. Am I right? So, is it balanced? Is the debit side equal to credit side? Is the debit side equal to credit side? Is the debit side equal to credit side? No. So, we have to make an adjustment. Where should we make the adjustment? Is it on the debit side or is it on the credit side? Where should we make the adjustment? In order to make it equal, we have to, we have to make an adjustment in the credit side. If the adjustment is made on the credit side, is it a profit or loss? Is it a profit or loss on this disposal? If the adjustment is made on the credit side, is it a profit or loss? Tell me. It's profit, right? So credit what? Profit on disposal. Profit on disposal. How much is it? 0.66 million. Do you guys have any single doubt in ROU? Tell me. Any doubts? Any minute doubts? Is it clear now? Is it clear now? Everyone, I want everyone's response. Is it clear now? Everyone in the class, come on. Is it clear now? Is the ROU concept clear? Will you be able to do problems based on this? Is it tough? Is it tough? Is ROU tough? Is this sale and leaseback tough? It's easy, right? Okay, fine. Okay, fine. So, which standard, which standard do you want me to take now? Which standard do you want me to take? Are you guys okay with the rest of the standards? Okay, I'll take IAS 12 tomorrow as we don't have much time. Do you have any doubts in small standards? Regarding the first, see, there are a few standards, right? From non-current assets. Do you have any doubts regarding non-current asset standards? See, I'll just list the standards out. That is IAS 16, IAS 40, IAS 20, IAS 23. Are you guys okay with IAS 23? Are you guys good with it? IAS 23. Okay, fine. What about IFRS 5? What about IFRS 5? IFRS 5 mainly deals with asset held for sale. Are you guys okay with asset held for sale, IFRS 5? What about impairment? What about impairment? IAS 36. What about IAS 38? See, I'll be taking IAS 12 and IAS 2 tomorrow. Don't worry. Okay. I'll be taking IAS 12 and IAS 2 tomorrow. And on the final 2 days, we'll be taking consolidation and the financial ratios that you have told me that you find it difficult. Okay. We'll cover it as well. So are the standards under non-current assets clear for you guys? Is it clear? No need to revise it, right? Are you guys okay with it? Are you guys okay with it? Okay. Now I want every one of you to tell me what all standards do they find difficulty in? I want everyone to respond. Which all standards do you guys find difficulty in? I want every one of you to respond so that I can cover it. So I can plan my schedules accordingly. Tell me, guys, which all standards do you find difficult? See, don't hesitate to tell me this, okay? To tell me, I'll be able to IAS 2 and IAS 12 bit confused. Okay, I'll be covering it. I will be covering it. Don't worry. Anything else? Are you guys good with agriculture? IAS 41. IAS 41, IAS 21. What about IAS 21 foreign currency? Are you guys good with it? Okay, okay, fine, fine, fine. Okay, okay, okay. Lease we have covered, right? Lease is also fine, right? Okay, okay, okay. What about employee benefits? IAS 19. Do you guys have it? IAS 19. Employee benefits. Okay, okay. Oh, sorry, sorry. It's not part of your syllabus, I guess. What about show? You guys don't have share-based payment as well, right? Okay, okay, fine, fine, fine. See, we have almost covered the major important standards. That is what IFRS 15. You guys are okay with IFRS 16 as well, right? We have covered non-current assets, and yeah, now what else is left is IAS 12. IAS 12 is very important, and IAS 2 also, I guess it's important. And what about IFRS 8 and all? You guys are good, right? Operating segments. Okay, 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 fine, fine, fine. See, so you guys are good with all the concepts, I believe. We have covered IFRS 9. We have covered IFRS 16. We have covered all the all the standards under. See, the non-current assets standards are very, very important. Okay. Just revise it just 2 days or 3 days before exam. It's very, very important. See, major questions comes from those standards. Okay. So just a reminder to revise all those things. So what else? For what else topics do you need help? Only on IS 12 and IS 2. Is there any other standards do you guys need help on? Is there any other standards? Is there any other standards that we need to take? Tell me, guys. Don't be hesitated. Tell me. Do you guys want me to take any other standards other than IAS 12 and IAS 2? Come on, guys. Tell me. IAS 41. IAS 41 agriculture. So I'll give you a brief right now. Okay. We have like 15 minutes left, right? I'll just give you a brief regarding IAS 41. What is IAS 41? So, tell me, what is IAS 41? What is IAS 41? What is covered under IAS 41? What is covered under IAS 41? Those who know, tell me. What is covered under IAS 41? What is covered under IAS 41? It's agriculture, right? IAS 41 is agriculture. IAS 41 is nothing but agriculture. Okay. So in agriculture, what are we dealing with? What kind of asset are we dealing with in agriculture? What kind of asset are we dealing with in agriculture? What kind of assets are we dealing with agriculture? Any idea? Exactly. It is biological assets, right? What is the difference between biological asset and a normal asset? What is the difference between biological asset and a normal asset? Tell me. What is the difference between biological asset and a normal asset? A normal asset. Exactly. Biological assets is nothing but living animal or plant. Living animal or plant that is purchased by the business. That is purchased by business. Whose cost can be measured. Whose cost can be measured and economic benefits can be incurred. Benefits can be incurred. Is this clear? Is this clear about biological assets? Is this clear, guys? Is the biological asset definition clear? I hope it's clear. So I'll give you an illustration, okay? I hope you guys are listening. I'll give you an illustration. So let's say we have a company. We have a company. Okay. So a company having a cow farm. Okay. A company having a cow farm. So in a cow farm, what will be the biological asset? What will be the biological asset? What will be the biological asset in the case of cow farm? It will be cow, right? It will be cow. So the major important point regarding IAS 41 is that, okay, now tell me, how do we recognize assets under IA 16? How do we recognize? How do we measure the initial value? On what basis do we measure the initial value in IA 16? In IA 16, how do we measure the assets? How do we measure the assets? Tell me. How do we initially recognize the assets? Yeah, exactly. We recognize it at its cost, right? We recognize it at its cost. But in the case of IAS 41, let's say on 1st Jan 2021, that is the opening. How will we recognize? How will we recognize biological asset? Initial value will be based on what? Let's say there are 100 cows. Okay. How many cows are there? There are 100 cows. So how do we measure this 100 cows? Initial value will be 100 into what? Is it cost? No, it's always fair cost to sell. There's always fair value minus cost to sell. Got it? Is it clear, guys? This is very, very important. Okay. This is how we this is how we initially recognize what biological asset. We recognize biological asset based on fair value minus cost to sell. Is this clear? If fair value is not there, you can use what? Cost. But in majority of the cases, fair value will be there. Okay. If fair value is not there, you can go for cost model. But if cost model is not, I mean, if fair value is there, you have to do what? We have to do what? Yeah. Okay, fine. So what if fair value is not available? We have to recognize it at its cost. So if you are using cost model, what should be charged? What should be charged? What should be charged? Depreciation. If you are using cost model, we should charge depreciation. But in majority of the cases, what will be the method? It will be fair value method, right? So will there be a depreciation on this cow? Will there be a depreciation? Will there be depreciation if you are using fair value model? Tell me. Will there be a depreciation? Will there be a depreciation? No, right? There will not be a depreciation because we are using what? Fair value model. So let's say the fair value of the cow is $2. Okay. So what will be the initial value? What will be the initial value? Let's say this is 12. This is 12. Not 2, it's 12. Let's say it is 12. The fair value is 12. So what will be the initial value of the cow? What will be the initial value of the cows? 100 into 12. How much is it? 1,200. 1,200 will be the initial value. Okay. Will there be any depreciation? Will there be any depreciation? Tell me. Will there be any depreciation? Will there be any depreciation? No, right? There won't be any depreciation. Right. Why? Because we are using fair value model. Got it. So what happens on 31st December? What will we do on 31st December 2020? What will we do on 31st December 2020? What will we do on 31st December 2020? What will be the value? What will be the closing value? We have to remeasure it, right? We have to remeasure it to what? Remeasure it to fair value minus cost to sell. Fair value minus cost to sell. Let's say the fair value is $40. The fair value is $40. So what will be the closing amount? What will be the closing amount? What will be the closing amount of the cow? What is the closing value of the biological asset? I want everyone of you to tell me. What will be the closing value of the cow? What will be the closing value of the biological asset? How much will it be? It will be 1,400, right? 100 into 12. Sorry, 100 into 14. So initially it was 1,200. Now it is 1,400. So what happened here? What happened here? I want every one of you to respond. What happened here? What happened here? Gain. Gain on what? Gain on biological asset. Gain on biological asset. How much is it? 200. Got it. Gain is 200. Okay. So how will we show this in the F? How will we show this in the F? We have 2020 FS. How will we show? How will we show this in the FS? Tell me. How will we show this in the FS? Yeah, exactly. In SOPL, we will show this as gain on bioasset. Gain on biological asset. How much is it? How much is it? 200, right? 200. Okay. What about SOFT? What will be shown in SOFT? What will be shown in SOFT? Biological asset at what? Biological asset at $1,007. See, the only difference or the only thing to be considered about IAS 41 is whenever we are valuing a biological asset, whenever we are valuing a biological asset, how will we initially recognize it? Based on which value? Tell me. Based on which value? Based on which value will you recognize biological asset? We will recognize it based on fair value. Is that clear, guys? Is it clear? Is this clear for everyone? Do you guys have any doubts? Any doubts regarding what all was taught today? Do you guys have any doubt with regards to the topics that have been taught today? Any doubts? Any doubts? Any minute doubts? You can ask me, don't hesitate. Is everything clear? Is it clear so far? Is it clear so far? I want everyone's response. Is it clear so far? Is it clear, guys? I want everyone's response. Okay. So we'll be covering IAS 12 and IAS 2 tomorrow. Let's see. Okay. So we'll wind up the session for today. And let's meet tomorrow then. Okay. Do you have any concerns with regard to this class? Do you have any concerns? Do you have any concerns? Are you guys able to understand the concepts? Or should I change my way of teaching? Should I continue it like this? Is it okay? Okay. Fine. Okay, guys. Then thank you. We'll wind up the session. Okay.